If you have bought a stock in the company or a house in a locality, what made you make a decision to buy it at the price you bought it for? What do you think? That you paid more for it or much less? Was it because a YouTuber told you to buy it looking at the charts and drawing few trend lines, or the price did not matter to you because someone told you that it is such a good quality company and the price does not matter? Well, if the only reason for you buying an asset is because someone else would be willing to pay a higher price for the same asset in the future, you are a fool. And this theory is called a greater fool theory. But since you're subscribed to the Better Investor, you do not have to be one. The top secret of making money in investing is to pay much less, as less as you can for an asset than what it really is worth for, which Warren Buffett says as buying $1 for 50 cents. And to make sure that we do not pay more than what the actual value of a house or an asset or a stock is, we must understand how we come to this thing called the actual value. The art of determining the value of an asset, be it stock or a house, is called valuation. And who can be the better person to learn this from other than Aswath Damodaran, who is an investor and professor in New York University and teaches equity valuation to the MBA and finance graduates. This is the Better Investor, helping you achieve your financial goals and freedom through organizing your finance, stock market investing, and learning from billionaires. And these are top 5 lessons from the book Little Book of Valuation, written by Aswath Damodaran. Lesson number 1. The cash flows. If you are a learning investor, you must have surely heard the word called cash flows. And to understand how to value a company, it is impossible to do so until and unless we understand what a cash flow is. It is compulsory for every company to release 3 documents for the general public. Firstly, the income statement, where a company declares how much worth of products did the company sell, how much was the expense, how many taxes did it pay, and how much profit did it make after paying the taxes. This is the most famous document that almost all investors are more or less versed with. Second, the balance sheet. The balance sheet is a document where a company lists down the value of all the assets of the company and liabilities. If you don't know what asset is something that gets money in your hand, and liabilities is something that takes out money from your hand. The last one, and the one which very few people see, is cash flow statement. Cash flow statement actually tells us that how much actual cash was there in our bank before the year or quarter started, and how this cash was used in which all activities, and after everything, how much cash is finally left in our bank account at the end of the year. A positive cash flow means that there actually was addition to the cash balance in bank, and negative cash flow means company has less cash than what it had before. But then you would ask, how is the cash flow statement different from the income statement? If a company makes profit, then the cash will be added to the company's bank account. Well, not. Let us understand this with an example. A company may have sold 100 soap to its dealer, the price of one soap being $2. But the shopkeeper may have not paid all the $200 right now. The shopkeeper may have told you that he will pay only 1/4 of the amount right now and rest at the end of the year. So in income statement, you will see that the total revenue, which is for how much did we sell our soaps, which in our case is $200. Let's consider cost of making one soap as $1. So the expense for making 100 soaps will be $100. So the profit comes out to be $200 minus $100, which is $100. For our example, consider that the company is debt-free and our company has to pay 20% in taxes on the profit. So 20% of $100. Tax comes out to be $20. The net profit comes out to be, that is $100 minus $20, which is $80. This is our net profit. But did this all $80 of cash came to your bank account? Let's see. In actual, you only received 1/4 of the money. So 1/4 of $200 is $50. And according to the income statement, you have to pay $20 as taxes. So after paying your taxes, you are only left with $50 minus $20. That is $30. So in income statement, you saw that the net profit is $80. But in actual, the company only has $30 of cash. It is easier for companies to fudge and cook hypothetical numbers in income statement, but not easy to fudge the cash flow statement, because all the transactions that are seen on cash flow statement are actually happening in the company's bank account, which in case of a fraud or scam can easily be checked by authorities. Thus, even Warren Buffett refers to cash flow as a better measure for companies' operation and capital management than an income statement. For this reason, it is prudent to look at both the income statement of earnings of the company and then the cash flow statement to see the quality and proof of these earnings. Lesson number 2. Relative valuation. Ultimately, there are dozens of valuation models, but only 2 valuation approaches, intrinsic and relative. Let's understand first what the relative approach is and how do we use it. You go to a locality in New York City to buy a house. There are these two houses next to each other selling for $1 million. They were built on the same day and they look just like each other. When you inquire, you find out what the rent people are paying who are living in them. The first family is paying $20,000 and the second family is paying $30,000. Which house will you buy? Obviously, you would buy the one that is earning higher rental income since the price of both the house is same. This is relative valuation. You compare two similar assets and see which is earning higher income to you in comparison to the price you're paying. Consider this now. First house is selling at $1 million, generating a rental income of $20,000 per year, and second house is selling at $3 million, generating a rental income of $70,000. Which will you buy now? You take price and divide it by earnings. So for first house, $1 million divided by $20,000 comes out to be 50. And for second house, $3 million divided by $70,000 comes out to be 42.8. This ratio is called price to earnings ratio and is very famous among investors. For the first house, ratio of 50 means that for $1 earning every year, I am paying $50 to buy this business. So it will take total 50 years to get all my money back from the investment. Price to earning ratio for the second house of 42.8 means that for $1 earning every year, I am paying $42.8 to buy this business. So it will take 42 years and 10 months for me to get all my money back from the second house. I am getting all my money back from the second investment much before than the first one. So the second one is more attractive. The thing that is true for a house is also true for a company. You can compare any ratio. Price with respect to revenue of the company, price with respect to the cash flow of the company, and etc. This looks very simple, but we need to understand that just like the example of two house, businesses in market may not be so identical. One may be older and thus more experienced than other. One may be more technologically advanced than the other. One may have more debt than the other. But more or less, relative valuation is the most basic approach towards making an investment decision. Some of the key ratios to carry out relative valuations other than price to earnings are as follows. Price to book value. Book value is what remains when you subtract all the liabilities from the assets of the company and then divide it by the number of shares that are there in the market called shares outstanding. Lower the price to book value, better it is, indicating that the price is cheap. Price to sales ratio or price to free cash flow ratio. It may so happen that the companies that you are interested to buy may not have any profits at all. For example, Google until 2009 was making losses. When comparing such companies, price to sales ratio or price to cash flow ratio may be a better metric. You do not have to pick up a paper, pen and do the maths. All these ratios are already available online. You can just Google them. But the things mentioned above, such as the experiences of the manager of the company, the growth potential of the company, etc., are also responsible for giving a company a higher valuation ratio with respect to its peers, which may be justified. Lesson number 3. The discount rate. Let's assume in 1970s, two people were given a choice between taking 5 rupees today in the year 1970 or taking 5 rupees in 2021. The first one took 5 rupees today, that is in the year 1970, and the other one decided to take it in 2021. The first one put the 5 rupees in bank, and considering average interest rate given by banks to be 6%, the 5 rupees in bank would have grown to 55 rupees in 2021. Or he could have bought 500 gram of Amul butter. Or he could have gone on a movie date with his girlfriend taking the luxury seat which then cost 1 rupees per person. Or he could have invested in Berkshire Hathaway, the company of world's greatest investor Warren Buffett, and those 5 rupees would have been 9,700 rupees by 2021. In every case that you assume, he is better off than the person who decided to take 5 rupees in 2021. This brings us to a very important concept, which is the same amount of money has less value in future, and this value decreases the more into the future you go. That is why the things you could do with just 5 rupees in 1970s could not be imagined in 2021 with same 5 rupees. In all the cases, the 5 rupees in 1970s have compounded at certain rate, because of which we are left with more than 5 rupees in 2021. In case of bank deposits, this rate was 6%. In case of Amul butter, it was at 10%. In case of investing in Berkshire Hathaway, it was 20.3%. Discount rate is exact opposite of compound interest rate. With the help of compound interest rate, we calculate the value of present money in the future. In case of discount rate, we calculate the future value of money in the present. Which means to say, in 1970s, you would say, if I was to have 55 rupees in 2021, what is that money equivalent to today if discount rate is 6%? And the answer would be 5 rupees. What would be the present value of 250 rupees of 2021 if the discount rate is 10%? The answer is 5 rupees. What would be the present value of 9,700 rupees of 2021 if the discount rate is 20%? Answer is 5 rupees. There is a mathematical formula if you want to know more about this, but you are better off using some online calculator for the same. Just look up for the term called present value calculator in Google and you can find plenty of them. Just like you can find compound interest calculator. This word called discount rate is many a times used by analysts. So next time they use it, you won't be a foreigner to it. Lesson number 4. Intrinsic valuation of the company. Intrinsic value of a company is the sum total of all the cash flow from present day until the last day of a holding. Any free cash that a business generates can either be reinvested in the business or can be distributed to the shareholders in the form of dividends. If it is reinvested in the business, then over time the book value per share, which is the difference between liabilities and assets, will increase because reinvesting in business means buying more assets. These can be buying plants, machines, acquiring other companies, etc. As the assets increase and liability remains same, the book value per share will increase. So if we say that the company is going to survive for 10 more years, then the intrinsic value of the company will be the new book value after increase in the book value per share plus all the dividends given by the company in these 10 years per share. So let us understand this with the example of KRBL, which is a global manufacturer of basmati rice. Here is a list of all the historic financial ratios of this company. I have got this from morningstar.com. What we are interested in is the book value per share. As you can see, 26.61 per share in 2012 to 144.86 per share in 2021, which is 20.7% annual growth in book value per annum. Now, we have to predict whether the company can continue to grow at such a pace for next 10 years. To be conservative, let's take from here on the company will start slowing its growth rate and would only grow by 15% in next 10 years. So if we do that, this is how the book value per share will be increasing. At the end of 10 years becomes 586.04. So if we consider in total how much of the money have we reinvested in the business at the end of 10 years, we come out with 441.18 rupees. Now we need to understand how much dividends would be paid in the next 10 years. As the company matures and it starts having more cash in the balance sheet, the dividend increases with time. As a conservative investor, we take that the dividends remain same as they are, which is 2.5 per share per year. So in 10 years, the total dividend paid would be 25 rupees. Now adding the money reinvested and the dividends given, we come up with 441.18 plus 25, which is rupees 466.18. Adding to this our present book value, 466.18 plus 144.86, which is rupees 611.08. So at the end of 10 years, this is going to be the amount generated by the business. Remember the discount rate. We have to find out what is 611.08 of 2030 equivalent to today. So now you may ask that at what discount rate must we consider? We must consider the discount rate as the annual returns that we expect from this investment. Taking this as 10%, the present value of 611.08 of 2030 at the discount rate of 10% comes out to be 235.08, which means that if we buy the stock of KRBL at this price and the company continues to reinvest in its business at 15% of its cash every year and distributes dividend of 2.5 rupees every year, then we must expect an annual return of 10% per annum from this investment. As we can see that the current price is around 245 rupees, which is higher than our calculated intrinsic value of 235.08. So we would not buy it here. We would only consider buying it when the price is significantly lower than our calculated intrinsic value. This is just one method. There are various other models too, but all of them discounts the future cash produced by the business into the present, just like our example. Lesson number 5. Valuations are most of the times wrong. As you have seen that the calculation of intrinsic value requires us to forecast and predict a lot of things, and in all likelihoods our forecast and predictions may go widely out of reality. As future unfolds, the operation of business may change, which you must not have ever thought of. Who knows exactly if a company would continue to reinvest in its business at the rate of 15% and not 5%? Who knows that the company will continue to give the same dividends? They may stop giving that at all. And on top of that, our assumption of discount rate of 10% from this investment may be over expectation. It may so happen that the economic environment goes for a toss and returns we would have expected from the business should have been 7% in place of 10%. Therefore, two people calculating the valuation of the company may come out with different intrinsic value. It is for this reason that in the stock market, some investors buy a particular stock since they think that the price is below the intrinsic value, whereas some people sell the stock since they think that the price is above the intrinsic value. Also, there is no need to be afraid of calculations and get demotivated. All the calculations involved are elementary mathematics and can be done by any calculators available online. And last but not the least, we must not forget what Warren Buffett said when asked by an investor about his formula for calculating intrinsic value. To those of you who don't know, in early days, Warren Buffett used to make money by selling newspapers. Warren Buffett said, if the investment decision that I have made in my life would have required me to use calculus and crunch numbers on calculators, I would have gone back to selling newspapers.
Let's have a quick recap. Cash flow is the amount of cash that is added to our company's bank account. Net profit that we see in income statement may not materialize into cash flow. For this reason, it is important to look at both the net profit in income statement and cash flows in the cash flow statement. Relative valuation is pitting two similar kind of assets against each other to see which one is better priced than the other one. Some important ratios are price to earning ratios, price to sales ratio, and price to cash flow ratio. Discount rate is used to calculate the present value of an amount in the future. A particular amount of cash in the present has less value in the future and the value reduces further the more into the future we go. It is better to take $1 today than $1 in the future. Intrinsic value of a company is the sum total of all the future cash flows from present till the last day of the business, discounted to the present value. Discount rate used to calculate present value must be taken as the rate of return expected from the investment. Most of the valuations are wrong. These include lot of forecasts and predictions that may never materialize. Two people having same data can come onto different intrinsic value and thus different opinions about whether to buy or sell a stock. That's it, guys. If you liked the video, please like, share and subscribe. Do leave a comment if you found this video useful. Feedbacks are most welcome. You can check out my past video about the book summary of concentrated investing. Until then, cheers guys.